So if a founder goes into an acquisition conversation not willing to share at least high-level financial information, I'd recommend just moving on until they are serious about selling.
That's Andrew Gazdecki, founder of Acquire.com, a marketplace where founders sell real businesses and buyers acquire them. Andrew and his team has helped over 2,000 plus founders exit and facilitate over $500 million in closed deals while building a network of 500,000 plus buyers across 100 different countries. Today, he's going to reveal why founders actually decide to sell versus what buyers assume.
Usually it's a combination of cashing in their chips, and then surprising number two is
the belief behind why founders overvalue their businesses.
When you read the headlines, those are only reporting on the extremes and the outlier acquisitions, because that's what's a headline story.
What makes a founder say yes to a lower offer?
Competition is the number one factor in acquisitions. And if that's the only offer, then that's going to be the best offer. Another reason would be
Andrew, buyers looks for motivated sellers so that they could get better deals. After helping over 2,000 founders exit, have you found any patterns where you could early detect if the founders has emotionally given up on their business even before they list it on the platform, so the buyers could reach out to them before their competitor does?
It depends. I think you can see a lot of it in the revenue of the business. For example, if the business revenue is declining, that can be a big sign that the founder has given up on the business. Another sign would be they've started another business. We see that a lot of times at Acquire, where the founder has already moved on and built something new and they're looking to sell the business so they can focus entirely on that. So those are two big ones.
Is there anything specific, like a specific question or something you guys do during the filtering process to figure out if they are being honest about why they're looking to sell the business or they're lying about it?
Yeah, we would just ask them like directly, like, why are you looking to sell? How long have you been thinking about selling? When are you looking to sell? When they're looking to sell can be a good question because that can give you insight into how quickly they want to sell. If they're looking to sell really fast, that's usually an indication that they're looking to move on from the business quickly. And then if they have a longer timeline, then they probably have more gas in the tank and they want to really maximize the exit.
I think that question also helps us understand if they are actually motivated to sell or maybe they are shopping around. So just save a lot of time.
Yeah.
So what are some of the common motivations you have seen on why these founders are looking to sell the businesses?
Usually it's a combination of cashing in their chips. They built a great business. One of the biggest paydays for founders is when they sell the business. So a lot of people, when they start businesses, they're thinking about, when could I potentially sell this down the line? So that's going to be the biggest one, is cashing in their chips, being able to really capitalize on what they built. And then surprising number two is started another company. A lot of the founders that we work with are serial founders where they're constantly starting different companies or different products. And the reason for that is maybe they started one business and their goal was to build a really large company. And if the company is showing that the trajectory to do that isn't really there for one reason or another, that's a great time to sell the business, start something new.
Okay, so it's not like they're emotionally burnt out or it's like some family issues, financial issues. That's not the common one you see. It's mainly it's like they have a new opportunity they're moving towards.
Yeah, ironically, that's not a good time to sell a business. When you wait until you're burnt out and the business is declining, buyers are going to see that. They're going to see that. And then you have a turnaround situation where you need to acquire the business, immediately fix things. We do see that, but less commonly. And more commonly, we see founders that have built a good business. Maybe it's profitable. They've automated parts in the business. They're no longer focusing their full effort on it, but it's a good business. And maybe a more specific example would be, let's say it's a SaaS company doing a few $100,000 in revenue per year. And of that is a few $100,000 in net profit per year, which is an exciting business. But the founder may have started the company to generate millions in revenue per year. So rather than just kind of hanging on to it until the business continues to decline or really declines at all, they'll look to sell that business and then move on to something else.
Most of the buyers mainly look for founders who are like emotional distress, something going on in their life, and they want to sell the business quick so that they could leverage it to get a good deal. So But you're saying that's very small amount of the market. But mainly majority of them are like looking for maybe to cash in and invest into their next opportunity. So how does the thinking process of the seller change from emotional distress founders to founders? They are like, we are making good money, we want to just cash in. Can buyers still get good deals since they are not desperate, to sell?
It really comes down to the business and the quality of the customers and the revenue. But when we work with founders, we're upfront of the valuations we see these types of businesses selling for. And that's just a reality of the market where we speak with buyers. We get an understanding of how they value small software companies, as an example. And then when we meet with founders, we just let them know that's kind of the range of where they see exiting happening. And then we connect those two people. So similar to when you sell a house, you go to market and you have an idea of what the market is selling for, what other homes are selling for. So we have comparable businesses that we share with founders and what we're seeing in the market. And then we share that with buyers as well. So there's always situations where we see acquisitions where a buyer, as an example, could get a great deal. But we view them as fair deals where both sides are aware of what the businesses trade for and what buyers should expect to pay and what founders should expect to sell for. And we connect those dots.
So when it comes to acquisitions, like honesty is everything. So out of all the founders you have like helped exit, have you noticed any patterns or have you found any way you could identify if they are being honest about their numbers or honest about, whatever they're saying or not?
You can verify all of that. It's really hard to lie through financials. It's also illegal too. So if you're lying about the quality of your business and you go to sell it, a buyer can sue you for misrepresentation. So it's very, very rare that we see situations where founders are lying. And if we do, we won't even approve them onto the marketplace. As a marketplace, Acquire only approves about 20% of the submissions that we see. So if we look at businesses, and we see this all the time where maybe they don't even own the business or something like that. We have a ton of different checks that we put a business through. We've seen some sophisticated scams and we reject all of those from our marketplace.
I think that is one of the advantage of using Acquire. So you guys would have already done the pre-wedding process. If a buyer is going off market, I think he has to go through the entire due diligence process to know that they are lying about it, of whatever the information they have provided you.
Yeah. Another thing is just off-market deals take a ton of work.
Oh, yeah.
Like you have to reach out to a founder. You have to find if they're interested in selling. Most aren't looking to sell at that point in time. You're going to need to collect a P&L. You're going to need a lot of other documentation. It's going to take longer to find off-market deals. And we work only with founders that are looking to sell immediately. And that can save buyers a ton of time and also headaches too, having to work with a founder that may not be educated or experienced in terms of selling their business, because it can be a confusing process with a ton of different hoops and things that you have to do. So we walk founders through that process. We help do some of the upfront due diligence for buyers just to make that process easier.
So like, what are some of the common things you have noticed the sellers hide from buyers?
Sellers don't hide anything from buyers.
Nothing.
We can't work with them if they do. And we don't necessarily work with, too many burnt out founders either, because it's just, they're harder acquisitions. Buyers aren't interested in those types of businesses. And if sellers are hiding stuff from buyers, that's not going to be a business that we can sell. So upfront on the first call that we have with founders, when we meet with them, we let them know that trust is everything in an acquisition process, because there's a lot of trust needed because both sides are taking on a lot of risk. So if we get any indication that we feel a founder is going to be trustworthy, we don't work with them.
So what's your thoughts on sellers who are like very rigid with sharing information and they just put too many hurdles to get the information we want?
What you just described would be a seller that's just not serious about selling. And if you're a buyer and you come across that, I'd recommend just moving on until they are serious about selling, because there's certain things that buyers need to evaluate and decide if this is a business worth acquiring. You have to have these things. So if a founder goes into an acquisition conversation not willing to share at least high level financial information, like a 36-month P&L, it's going to be a really, really hard process for that founder. And from what I've seen in my experience, when we do see that, buyers just quickly move on because the founder needs to make a buyer's life easy and then put themselves in the shoes of a buyer and understand how they evaluate businesses, what they need to get to an LOI. And then when they do get to an LOI, for the founders that we work with, generally, no, they're not hard to work with because at that point, you should be on the same page with the buyer. So you should be at a point where you both agree that you are going to do this transaction at this price with these terms and have at least a high level understanding of the next steps, which is due diligence, where you have to share more information. Because if you don't, the whole deal can fall apart and you can't move forward.
Real quick, guys, each of these episodes represents over 30 hours of my personal work, not including my post-production team's time. I'm building this podcast to become the number one resource for business acquisitions, and the only way that's going to happen is through your feedback. So please drop a comment with a timestamp for the parts that you found valuable or not helpful. If you're on audio platforms, you can leave a review. This will help me understand what you like, what you don't like, so I can create exactly the content you want to see. Thanks for your support. Now back to the podcast. What are some of the common ways, these sellers price their business versus compared to how market looks at it? And where do you think is the gap?
We talk about this a lot at Acquire. We actually just had a team meeting around just valuation education just this week. It's something that we're constantly doing our best to educate founders on. But my last startup, I used to have a small seed investor, and he would tell me that SaaS companies sell for 10 times revenue. So we'd get to $1 million revenue and he'd say, oh, you're worth 10 million. Got to 20 million. And it felt great. And some businesses do sell for 10, 20 times revenue. But those are going to be the outliers. Those are the extreme cases. And those typically get all the headlines too. So those are going to be the companies that you hear about most as a founder. But there's a lot of factors that drive into that valuation, such as competition. How many other businesses were submitting offers? How fast is the startup growing? Is it at scale? Meaning, is it above 10 million in recurring revenue? And then the businesses we work with are generally going to be below that, where the growth rates are going to be lower. They're not going to be at scale. They're not going to have competition from Google and Facebook and Apple bidding for their company. And so that changes who you sell to. Typically, it's going to be a financial buyer, because you have financial buyers and strategic buyers. Strategic buyers are the big companies that can offer crazy multiples that every founder should aspire to sell to. But the reality is most businesses will sell to a financial buyer, private equity firm, or even a individual who's an executive at a tech company and wants to operate as a CEO. So we do our best to educate founders on that market reality. We'll point to recent acquisitions that we've done, at what multiple, how we got there. And then we'll even point to the public markets. Like, for example, PagerDuty is a public company, and there was a post going around recently on Twitter where they're at 500 million in recurring revenue. They're trading publicly at 2.1 times revenue.
Yeah.
Because growth has stalled. So if you don't have extreme growth at scale, it's really hard to command, anything beyond 5 times revenue.
So what do you think makes a seller accept a little lower offer than what they have put it on the listing for?
It's a good question. I think it depends on the competition. Competition is the number one factor in acquisitions. What drives up the price, what gets you better terms. In some situations, they may not have a lot of competition. Maybe they're only seeing 1 or 2 offers for their business. And if that's the only offer, then that's going to be the best offer. And so we recommend founders take that offer, even if it's a little lower. Another reason would be maybe the buyer is really easy to work with. Maybe the buyer understands what the founder wants to do post-acquisition, which could be leave the business immediately. Maybe they have a plan to grow the startup further than the founder was able to. So factors like that. Maybe it's not all about the cash. Maybe they want to see their customers or their team taken care of. Or the buyer was just a really easy person to work with and wasn't going to give any headaches. We see that a lot where if they're an experienced buyer and they can close in say 2-3 weeks, they can actually win out on offers that may be a little higher. Speed, ease, no headaches. Because it's heartbreaking when you go down an acquisition process with a buyer and they have an offer and it falls apart, at the ninth hour. So just having that assurity as you sign that and you go through due diligence and you spend all this time working to close a deal, that can be worth a discount.
What beliefs do you think these sellers are clinging on to, thinking their business is worth so much compared to what it's really worth?
It's going to depend on the person, but I think just how much time is spent building startups. And then just what you hear in the marketplace from big headlines. XYZ company bought XYZ company for several million or billion. I think headlines like that can sway because when you read the headlines, those are only reporting on the extremes and the outlier acquisitions because that's what's a headline story. But just again, all the blood, sweat, and tears that goes into building a business. When you go down that journey as an entrepreneur, you want to maximize your exit, and that's what we work on founders to do.
Because I think the only way for us to get a better deal is to pretty much educate the seller, and if they understand it, that's good to go. If not, we just gotta wait until if they will see that okay, we are not getting any offers, and they might come back to us saying, okay, I understand this is the realistic value of the business.
Yeah, just understanding the market realities.
So you mentioned if you have speed or ease of getting the deal done, you might get a discount on the purchase prices. So apart from the price, what are other things founders value more that could get a discount on the price?
Taking care of their team, taking care of their customers. Let's say they're interested in, the highest valuation, like that's their goal. There's ways to get there that also work for a buyer. For example, you can do an earnout, you can do seller financing. So you can bridge that gap with creative deal structuring. But if they want all cash at close, meaning every dollar hits their bank account when they close, that's another way to win a deal. But taking care of their team, taking care of their customer, being easy to work with, being able to close fast, all cash at close, those are going to be the top ones.
What is the most common deal structure you look at acquire? Is it just all cash close or sellers are open to seller financing or earnouts?
We see a mix. It's going to depend entirely on the competition within the deal. So how many buyers are interested? How much leverage does the founder have during these negotiations? If there's a lot of different offers, that's where you start to see a lot of cash on close offers. Because initially you may receive offers that aren't cash on close, where it's going to be 80% cash, 20% held back from a certain point. Maybe it's an earnout, maybe it's seller financing. We see a combination of that. And then if there's multiple offers, you can go back to buyers and negotiate better terms. So it depends, but we see both. I'd say about 30% are seller financing, 30% have some component of an earnout, and then 40% are all cash at close.
We had a seller. It was an e-commerce brand. We worked on finding a buyer for it. It was a dropshipping store, which was really, really hard to find a buyer for. But we ended up finding a buyer. The buyer put the money in escrow. And literally at the day of closing, the seller is like, I think we could get a better offer. And he backed out. So I'm pretty sure you might have seen founders getting cold feet. So what do you think usually triggers it?
One time we saw two brothers fighting over the final deal terms. But way more commonly, we see buyers getting cold feet for one reason or another. Maybe business needs change. Maybe it was a product they were going to add into their portfolio and something shifted. Maybe financing fell out. But more often than not, we see it on the buy side, not so much on the sell side.
So what are some of the things a buyer can do to gain the trust of a seller, before they even start the process?
Is this after they've signed an LOI?
No, before. Let's say they start having conversations, or you could say before and after, if there are ways to make it happen.
I mean, getting on a plane and going to meet them is a big one. If they're willing to invest the time, it's all about investing. And what I mean there is, how much time are you willing to invest? Are you willing to go and meet that person? Are you willing to understand the founder's goals with the acquisition. Because that's a great question, is what's your main goals when you sell this business? It could be, I want to sell this for as much money as I possibly can. And then you ask, okay, is the final sale number the most important, or is all cash at close important? How do you want your customers to be taken care of? So understanding what's important to the founder can be a big one. And then also just being easy to work with. Don't be a jerk. Don't be rude. If you decide to pass on the business, give an explanation for that. Don't ghost founders. Just common things like that can go a long way.
Any specific type of buyers these sellers like to work with?
Ones that have experience in the industry that they're in is a big one. For example, we helped an Excel-based startup sell recently, and they sold to a person in the finance industry. And there was, I believe, 8 other offers on this specific deal. And this individual just had a lot of industry knowledge in that space. So that can absolutely help you stand out.
Do you think the personal branding aspects of it matters as well, like who the buyer is or which company, they're buying for?
Yeah, reputation, it can help a lot, but it's not necessarily required. For example, there's a few private equity firms that we work with, and they're very well known for the acquisitions they've done and how quick they do due diligence and what other founders say about them. That can be massive. Because again, as a founder, one of your biggest fears is signing an LOI and the buyer backing out in the last minute. So if there's anything you can do to figure out who has the highest chance of close, you're going to look to that. So that's where reputation and brand can really help buyers. I'd say it's one of the most powerful things because again, our job at Acquire, when we see multiple offer situations, is we're typically going to meet with each buyer and we're going to try and get understanding of who has the highest chance of closing? Meaning, do they have the funds on hand? Do they have acquisition experience? What does due diligence look like in terms of the timeline? Have they thought of these things at all? So when you have a reputation, we already have a lot of insight into your experience, what others are going to say about you for acquisitions. But it's not required. We work with a lot of first-time buyers, and that's where we rely on just preparation, just having a decent plan of what's going to happen if we move forward with the buyer. But it's definitely helpful.
So what are some of the things buyers think they know about a seller, but that's not true? Like what are some of the things, they misunderstand about a seller?
Maybe how easy the business can be to run. I can see that from time to time. But I don't come across too many large pre-assumptions of founders or businesses. But if anything, I'd say that. Maybe valuing it a different way, that's another big one.
You look at Acquire, a lot of sellers, have a conversation with a lot of them. So are there anything interesting that you want to share with the buyers on how they think?
I mean, every buyer is looking for a good deal. At the end of the day, you're buying something, you're not trying to overpay. So the main thing to understand is any area that you show as maybe you're unprepared or this is a process that's not competitive, that's giving buyers an opportunity to value your business lower. For example, if you don't have a P&L readily available, or if you're not prepared for questions as they send them, you're slow to respond. All these little things add up in a buyer's head and gives them the view that this isn't a competitive deal situation and they're likely going to be the only buyer. And in those situations, offers tend to be the lowest. So I'd say just being aware when you go to market, first impressions really matter.
You have just seen how founders think when they decide to exit. But that still doesn't explain why most of the profitable businesses never sell. That's where Tim Schumacher comes in. Tim has bought over 25 plus SaaS companies and does nearly 100 million in ARR and reveals the exact deal killers that makes buyers walk away. Watch it here.